What's up, guys? Today we're talking about a few reasons why you might be losing money when you're yield farming. Have you guys ever wondered why you're losing money even though you're applying all of the right strategies or the different strategies that you're seeing online, even though you followed the instructions and your portfolio is still struggling? Hopefully this video would explain a couple of reasons why your portfolio might be struggling right now. If you guys are new here, my name is Richard. I'm a yield farmer and investor. You can see some of my positions here are struggling a little bit, like this pixel to ETH pool, but most of my other positions are doing okay. Mid to small cap altcoins have been struggling a little bit when we're comparing with Ethereum. So the Ethereum profit and loss is not looking too good. Still beating holding in the market with my core positions. I have some other positions as well, like this pendle to ETH or these smaller positions here in other wallets. Overall down a little bit in Ethereum terms, but the US dollar value is still holding up pretty well. The low of my portfolio this year is around 70 to 80K, so not too bad. So let's dive right into the video. And just a quick disclaimer, none of this is financial advice. I'm not your financial advisor, so please do your own research before making any investment decision. So the first reason why a lot of people lose money yield farming comes back to short-term thinking. It doesn't matter which pair you're yield farming, if you're yield farming crypto to crypto pools or crypto to stable pools like Ethereum to USDC. If you guys are trying to make a ton of money in the span of 1 to 3 months, typically you're going to be taking much more risk than a longer term investor like myself. So what I like to do instead is I have some positions that are meant to be really long term. For example, every single month I buy a little bit of Bitcoin with the fees that I earn so that I decrease the risk of my altcoin portfolio while still earning really nice yield. Even though Bitcoin's price is arguably high, but I'm buying these assets for the next 10 to 15 years or even 20 to 30 years. Because I believe that these assets would be worth more in the future, I don't really care about the short-term price action. But what a lot of people do when it comes to yield farming is that they just squeeze the range really hard because they're trying to maximize the fees. For example, if we drop to a daily chart, some people might set the range like this, right? Their bottom range might be around 3,300, and then the upper range might be around 4,000. So this is quite a tight range here. You can see if we just zoom out on Ethereum's chart, the prices tend to be pretty volatile here. They tend to not move sideways for a very long time. And even if it does, like what we see a few months back, you can see the price move sideways for about 2 months before it pushes higher, right? And if I extend the range back here, you can see this wide of a range typically does not capture a lot of price action at all. And what some people do is if the price move up, you chase the range upwards, right? So let's say you started yield farming here a few months back. You were squeezing the range to get like more fees out of it. Maybe you've made like 10 to 20% ROI on your capital if the APR was good. Then the prices move up. You actually do not get a lot of capital gains because with a tight range strategy, your Ethereum is going to be converted very quickly to the stablecoin pair like USDC or USDT, whatever you're pairing Ethereum with in the pool. And then what a lot of people do is they end up with USDC, they chase the range upwards, right? And then when the prices drop, like what it did back here, they're losing a ton of US dollar value because again, the conversion rate is going to be very aggressive. When the prices do drop, you're going to be fully in Ethereum. And if the drawdown is pretty severe, you could see like a loss of more than 50%, right? So this is why I don't prefer like really tight ranges and the short-term strategy of trying to make a ton of income because the risk of loss is much higher. We can't tell where the market is going to go next, right? Sometimes the price looks like it might be going sideways here, and then suddenly it shoots up, moves sideways again, and then shoots up pretty aggressively. So it's very hard to predict where the volatility is going to come and go. So in my opinion, it's just not worth the risk to be squeezing the range with a tight range strategy. And there's even more crazy strategy like the 1% range they set on each side of a crypto to stable pool. You might be printing a ton of fees with that type of strategy, but the problem again is if the market dumps really hard, a lot of your gains are going to be wiped out, right? So that's something to keep in mind. if you guys run very high risk and short-term strategies. A lot of these comes down to just short-term thinking. If you guys are trying to, go for like 2 to 300% APR or even 100% APR on blue chip assets, a lot of times we are taking on much more risk. What I like to do instead is to look at the weekly chart and even the monthly chart in some cases to try to predict where the prices is going to go, and I set a range where I would likely be in range for at least the next 6 to 12 months, right? For example, on the monthly chart, we could see the momentum is positive. The RSI is not close to overbought yet. If I expect further upside, for example, my bottom range might be around $2,000 if I want to add a little bit of a buffer here in case the prices do drop below like this 50-month simple moving average here, the yellow line. I will still have a little bit of a room and less of a drawdown compared to just holding Ethereum. And if I want to optimize for more capital gains, I could set the upper range to be at around $15,000 or even higher, right? So with this wide of a range, I would most likely be in range for at least 6 to 12 months and maybe potentially even years here, where I would suffer much less apparent loss, and I would also earn a ton of fees when these tight range liquidity pools get knocked out of range if we do see an aggressive pump to the upside. And then the second reason why you might be losing money when you're yield farming is that you don't know the potential downside of your strategy or the investment that you're making. For example, a wide range strategy like this, there are potential downsides as well. The most obvious one is we have less fees compared with a tighter range strategy, right? But there are a lot of benefits, like there's less apparent loss. It's much easier to outperform holding in the market with a wide range strategy. For a crypto to stable pool, that's pretty straightforward there. The downside is not that much for a wider range strategy. But if we're looking at a tight range strategy, there are a ton of downside to consider. The benefit is you're going to get a ton of fees, right? If you guys have a tight range like this. But the problem is if the prices move up aggressively to the upside, you're missing out on the pump. Unless you guys have a lot of Ethereum on the side that you're not yield farming with, then this strategy could still be good to generate some cash flow. But again, you're going to miss out on the pump with whatever asset that is in the LP. And on the flip side, you're going to suffer much more drawdown if the prices do drop, right? Again, the conversion rate is very aggressive. When it exits your bottom range, you're fully into Ethereum here. So let's say your bottom range is at like $3,400, right? So when it exits, you're fully in Ethereum. And then if Ethereum goes to do another 50% drawdown, which happens in the bull market all the time, you're going to be suffering a lot of apparent loss and earn little to no yield unless you decide to rebalance. And in that case, you're going to be locking in a lot of apparent loss, right? So before we even enter into a position, we should know the downside of our investment and know exactly how you're going to lose money before we even put the money in, right? For example, a lot of my positions are altcoin pairs. How can I lose money with this type of strategy? Well, for example, if Bonk and Ethereum does really well, then my portfolio is very likely going to be in a positive, right? Especially if Bonk is outpacing Ethereum, which it has been for quite a while until the recent pullback. It's still trading above my entry in Ethereum terms. So I'm still net positive in Ethereum terms, still outperforming holding in the market. But if it starts to significantly underperform Ethereum, I would have a negative Ethereum divergence loss here. Like for example, this syrup and ETH pool that I just got in, I'm sitting in 13% loss on my initial investment because of this negative apparent loss here. So that's the downside with altcoin pairs. We're trying to bet on outperformance. And if it's underperforming Ethereum, we will be losing some of this money here. And another way we could lose money with these type of pools is that if Syrup and Ethereum both drop in US dollar value, right? When that happens, we will be suffering a much sharper drawdown compared to a crypto to stable pool or comparing to just holding Ethereum in the market. Because a lot of times, if the market condition is really bad, these smaller cap altcoins are going to drop more than Ethereum, right? So that's a potential risk there. Always know your risk and always know how you can lose money before you even hop into the pool. And an analogy I really like for this is I used to teach martial arts back when I lived in Southern California. And one of the most common ways that people lose money when teaching martial arts or opening a martial arts school is two things. The first is renting a space that is too large. A lot of times, if the rent is too expensive, you're going to need a lot of students to basically cover your costs, right? And because you need a lot of students, you actually need to hire more staff. And that could also eat into your profit margin and make the business model really high risk and not profitable, right? So it's a little bit unrelated to yield farming, but the idea is the same. If you guys don't know the downside of each strategy and how you could potentially lose money, then it's going to be very likely that you're not hedging your bets or taking steps to minimize your losses. For example, like I said, altcoins have been struggling against Ethereum a little bit, but because I know that these altcoin pairs are a little bit higher risk, what I do every single month is take some of those fees to convert either into Ethereum or into Bitcoin to decrease my risk over time, while also stabling up some of my profits if Ethereum is trading at a high price. The third reason why you might be losing money is applying a bad strategy. So we just talked about like tight range strategies, right? Especially on crypto to stable pairs. And if you're chasing the range, a lot of times your fees are not going to be enough to cover the inherent loss. Let's say you started yield farming here and then the prices drop, you chase a range like this, locking in a ton of inherent loss. As the price drop, you move the range further down and then further down here. And then when the price reverses, you basically missed out on a ton of the upside while locking in a ton of inherent loss, right? So that is an example of a bad strategy. Or if you guys are yield farming crypto to crypto pairs, a lot of times we want to try our best to get in at a good entry. If you guys get in the same pool that I'm in, for example, Bonk to Ethereum, but your entry is all the way up here, and then you use a tight range strategy, then the risk profile for your pool is much more different than mine, right? I might be sitting in a profit while you're sitting in a large loss because you entered at the wrong time, and then you use a tight range strategy, which then could be causing the loss. So two people yield farming the same pair could have really different results, right? So that's something to understand as well. And another very popular strategy is a delta neutral strategy. I see a ton of it pop up when Ethereum started trending down very aggressively. But a lot of times when the prices are already cheap, for example, Ethereum is at $2,300 here, I actually don't want to implement a delta neutral strategy, right? Because even though it protects my portfolio from the downside here, if I don't flip back to a long position, or if I was just simply wrong and the market moves up higher, I would miss out on all of the upside, right? That's why I don't like to use delta neutral strategies when the prices are cheap. For example, back here, when the price is at 2,500, if you went on a delta neutral strategy with a big portion of your portfolio, you would likely miss out on this pump here, right? But if you applied a delta neutral strategy when the prices are high, where it's near $4,000 for Ethereum, for example, then the risk and reward is much better in that case, right? So a great strategy applied at the wrong time is a bad strategy. So we always want to think about where the prices are and what it's likely to do in the future so that we could position ourselves to capture the move upwards. The fourth reason why you might be losing money is from bad position management. So let's take a look at an example here. For example, this is Pendle to Ethereum. So this is the current pool that I'm in. You can see the orange lines here. The green is my entry. It's still trending down against Ethereum here and is being priced in Ethereum terms. So to buy one Pendle token, it would cost me 0.001 Ethereum right now. And I entered up here roughly at 0.0012. So not the perfect entry. I'm not trying to, get like the absolutely bottom entry, but objectively based on the historical performance and what it's likely to do in the future, Pendle is cheap compared to Ethereum. That's why I entered into this pool. And one very simple strategy that I like to do is when prices are trading below my entry, I typically do not want to exit for a loss. especially if the underperformance is because of the market condition, or if I'm waiting for a specific catalyst that has not come into play yet and my thesis is still intact. I'm not going to sell my position for a loss, right? So that's the first part of position management. Based on my analysis, if the prices are likely to recover, I'm not going to cut my losses. And in fact, what I would do is compound more of my fees when the prices are low. And what this does is it basically adds more capital to the LP, and then it's going to drag my entry down, especially if the prices drop really aggressively. I could be compounding more and dragging down my entry. And you can see if your entry gets lower and lower, it becomes much easier to make a profit when the prices swing back up, right? And the capital gain would be much more as well because we're basically buying low. When the prices swing back up, let's say the price swings back up here in this zone of resistance, I could choose to exit this pool completely into Ethereum for a very nice Ethereum profit, right? And then if Ethereum is doing well as well, I could also exit into stablecoins. It sounds very simple, but a lot of people don't do this. This has been like the bread and butter of my main strategy, and is still something that I apply every single month. We got to be very mindful of our entries and our exits. If you guys entered all the way up here, for example, and you're still in this asset for the long run for at least 6 to 12 months or 2 to 3 years, then we could be compounding our fees down, right? And then if the prices do shoot up as what you expected, you could choose to take profits. So position management is very important. Like I've said earlier in this video, two different people yield farming the same pair could have drastically different results based on stuff like entry, exit, the range they set, when they choose to compound, when they choose to de-risk, right? When the prices are high, I like to de-risk, sell my fees, or exit the position completely if I want to lock in my profits. And the fifth reason why you might be losing money with yield farming is that you're simply unlucky, right? For example, if you guys hold a lot of Ethereum, last year it was underperforming a lot of altcoins. The prices were relatively weak, and then we see a lot of capitulation down here, along with some really negative news of the Trump tariffs, which caused a lot of uncertainty in the market, right? The market doesn't like uncertainty, so the price action was very negative, even though the asset is really solid. And you can see altcoins as a whole also suffered a huge drawdown, right? So you could be doing everything right if you're yield farming altcoin pairs, you're applying all of the best practices, but your portfolio would still lose money because of the market condition or because of negative catalysts that we didn't see coming, right? For example, the last bear market, we had a pretty brutal drawdown with the FTX collapse. And I would argue that if there wasn't like a big collapse like that, the prices would probably not go down that much, right? So that's why we always should be hedging our bets. For example, in these coming months, I'm selling more and more of my fees more aggressively into stablecoins or into crypto to stable pools to hedge my bets in case these things go wrong. But again, sometimes you're just unlucky. You could be doing all the analysis, but again, we can't tell the future, right? Even with these assets like Pendle, for example, I did my research on Pendle. I'm very bullish on the project, but who knows, in the future, it could not perform well. We never know what's going to happen. And this is why we diversify our investments. If you guys look at my pools, it's not all into one asset, right? There's a lot of different assets here. Pendle, Syrup, Pixel has been struggling a little bit, but you can see I'm not just yield farming 1 to 2 pairs at a time because in my opinion, that is just too high risk. And I've also been stacking Bitcoin and Ethereum as well to reduce my risk over time. And that's the nature of altcoin investing, right? Sometimes you will make a lot of wins. Sometimes there will be a lot of losses. And if you guys are not comfortable in that, then we should be sticking with just mainly blue chip assets like Ethereum and Bitcoin rather than have a high risk portfolio like I do, right? But if you guys are yield farming altcoin pairs like I am, you have to be comfortable with the fluctuation in the market and the variance that happens in your portfolio. You're not going to make a profit on every single pair. You could be making wrong decisions. But as long as we're learning from it and then we're improving from there, it's still worth it to do, in my opinion. So just a quick recap of the 5 reasons why you might be losing money from yield farming. The first is just short-term thinking. The crypto price fluctuates by a lot. Sometimes my portfolio go down by quite a lot, but it also goes up by a lot. As long as I'm making a profit over time, the fluctuation shouldn't really matter too much, right? The second reason why you might be losing money is not knowing the potential downside of your strategy. For example, if you're yield farming crypto to stable pairs, you should know what the downside and the drawback is, how you can potentially lose money in that situation, so you can make different hedges against that. For example, my altcoin portfolio is pretty high risk, so I hedge pretty heavily by selling some of my fees into either Ethereum or Bitcoin or stable coins if the prices are good. The third reason why you might be losing money is choosing a bad strategy, like a very tight range strategy or a range chasing strategy. In my opinion, those strategies would just underperform over time because the prices are very volatile. You can't really predict where the prices are going to go. Tight ranges suffer a huge drawdown if the market pulls back by a lot. The fourth is bad position management. If you guys are, for example, exiting your pools when the prices are cheap and then entering when the prices are high, that's a great way to lose money. If you're not very conscious about which assets you're swapping from and why, you can lose a ton of money in the process. And the fifth reason is that you could be just a little bit unlucky. There are a lot of future events we can't predict. We just need to hold through the drawdowns, make sure that we're doing everything we can, controlling what we can, and just let the market do its things, right? If you guys found that helpful, then be sure to subscribe and check out other videos on my channel. I talk mainly about yield farming and investing. Hopefully these videos help you guys out so that you can make more profits over time and also avoid some of the painful mistakes that I've made. Thanks once again for watching. I'll catch you guys next time.